You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Welcome back, everybody. Welcome back, Brandon. How are you doing on this fine Thursday morning?
Hello, sir. I am doing rather well. Hey, just quickly, before we get started, follow up. You know how we were talking about the Hood Ipo last week?
Oh, yes.
Do you remember?
We made some I can't remember what we predicted. You'll have to run us through it again.
Well, I will tell you. Hamish, you predicted that this week Robinhood would be at $90 to $100 a share.
Okay.
I went bold and I said Robinhood was going to be at $150, give or take $5.
Mm-hmm.
And because I was just like, I was going all in on my thesis that Robinhood was going to be the next meme stock. Turns out Robinhood currently sits at $51.19.
Wow.
So we were not...
Where was it at the start of the week? Okay, so at the start of the week, it was about $60.
It was like when we made the prediction, it was at like $70.
$70, right, okay. Yeah. Wow, so it's actually come off quite significantly. Wow. Well, there you go. I said I didn't want to make a prediction, and that's why.
Stick to it. We better stick to our day jobs.
Oh, speaking about getting things wrong as well, we started the last podcast and I was happy. I was saying that the COVID cases in Melbourne had kind of gone down. This week, we're back in another lockdown. So.
Oh, really? Oh, man.
So, yeah.
That sucks.
Yeah, it's been quite a yo-yo kind of experience over the past few months. So we're back in another lockdown for another couple of weeks. So
I'm sure Sydney's the same. How bad is it? How many daily cases are you guys adding in Melbourne?
Yeah, the last few days at the moment's been about 20 cases a day.
Okay,
higher than we've had for a really long time. But I mean, if you compare that to Sydney, I think Sydney this morning had 340 or something like that. So.
Yeah, they're in trouble.
Yeah. But yeah, I mean, it is what it is. Here's what it is.
Yeah. We can't do much about it. Just want to get our vaccines going. Let's get some more vaccines already.
Yeah, I think we just got another contract with Moderna, I think, for the first time.
All right.
We're going to get some Moderna here in Australia, but I don't know. Hopefully the timeline can speed up a little bit. Last time I checked, I think they were on track to have like 70% of people vaccinated by February next year or something crazy.
Wow.
Which is so far away.
It's just not fast enough, is it?
No, it's just not good enough.
Anyway.
Yeah.
So it just gets you in such a down mood thinking about all this. It's crazy that, well, first of all, it is, when you think about it, it's crazy that we've got viable vaccines like after a year and a bit.
Yeah.
But then again, I mean, I can't help but look back and just be like, man, this has been going since it's COVID-19. It's been going since late 2019 and it's now August in 2021 and it's still like, I wonder how many times you've either said or heard the word COVID-19 in the past 2 years. It'd be a lot.
God, yeah, it's crazy. Yeah, I mean, I guess if you look in the scheme of like vaccines generally over time, I mean, a year is quick, but doesn't feel quick when you're living it. So
yeah, a year is lightning.
Yeah.
But anyway, I just don't want to talk about COVID.
No, that's enough.
Such a downer.
Right. No more.
What are we talking about? I'm going to talk a little bit about the Olympics, which might be interesting. The economics of the Olympics. Some people might know the Olympics is not, the economics aren't great. Also got an interesting story about fashion turning into quite bad landfill and the business that thrives off of that system. So we'll talk about that. That's quite interesting. I saw that article this morning. I just read the whole thing. I was so interested. Inflation numbers are here for July.
Ooh.
And what are you talking about? A little bit more on what Phil Town's moves were in the past quarter.
Yeah, so we've got his SEC filing for the Rule 1 fund. So get to take a look at what moves he's been making in the markets.
Right. Okay. Well, let's get stuck into it then.
Yeah. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So basically, you can pull in all of your trades either manually or automatically from one of the associated, if you're with one of the associated brokers, which is pretty much most of the major brokers. So it's very likely you'll be able to do that. And it'll basically allow you to track all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you just hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan. You can track up to 10 holdings for as long as you want. Or you can also use that link if you want to sign up to a paid plan for more features. And if you do use that link, you'll get 4 months off a yearly subscription. So go check it out if you're interested. And once again, thanks to everyone who has used that link to sign up to Sharesight and is supporting the podcast.
Absolutely. Where do you want to start today?
Yeah, I mean, we could start with let's go through these inflation numbers because this is probably, I mean, maybe it's not that interesting to people, but it's probably honestly the biggest headline in the finance world.
It's quite important
on a month by month basis. It is, and it's something that everyone is watching, and we've spoken about it a lot of times on the podcast because if inflation continues to rise, then maybe the Federal Reserve has to raise interest rates to combat that, and the raising of interest rates is would put downward pressure on stock prices. So we're in a very sensitive situation right now where if inflation continues to run, it could be very bad news for stocks. If it doesn't, if it reverts back to very, very low levels like we've seen for a long time, then the stock market will probably continue to rally and experience gains. So it's a very important thing that we're watching at the moment. And we've today, just this morning, gotten in July's US inflation numbers. So on a year-over-year basis, inflation came in at 5.4%. And just for reference, the ideal range that the Federal Reserve is looking for is between 2% and 3%. So we're still seeing inflation that's outside of that range, considerably higher than that range. But of course, we are looking at year-over-year data. So we're looking at a comparison in prices between now and a time when we were probably in the deepest part of the pandemic, where there was considerable price declines in a lot of areas. So 5.4%, actually the same as last month. So exact same year-over-year
That's interesting.
figure. Yeah. So, I mean, up until this point this year, we've kind of seen increases in the year-over-year inflation. This is the first time we've seen flat from of the year-over-year from month to month. And that kind of, for some people, will indicate that we're reaching kind of the top of a bell curve kind of chart. Like we've just had this massive increase in inflation. It's going to come back down, or it could be somewhat of an inflection point. Of course, we don't really know what it's going to look like. Same as expectations as well.
Okay.
Very interesting. Actually matched the largest increase since August 2008. So both last month and this month were, of course, the same. And it's the biggest in, 13 years or so, which is interesting. I think the month-over-month data is probably more important to look at because, as I mentioned, the year-over-year, you're kind of comparing last year to this year. And last year was a little fairly abnormal. I think people can recognize that. Whereas month over month, where we're comparing increases from, say, in this case, from June to July, that's just this year. So that's just continued inflation. Month over month inflation came in at 0.5%, which sounds low, and it actually is lower than last month. The month over month last month was 0.9%. But 0.5% is not small.
Just if you extrapolate that across 12 months,
Exactly. So if you're getting 5% compounded every single month over month for a year, you're looking at a 6% annual inflation rate, which is really high, about twice as high as what we would be comfortable seeing on a consistent basis over time. So it is slowing down the month over month. It's 1% last month was crazy. That's just a ridiculous amount. We went from seeing 1% inflation for entire years for many years to 1% in a month, which is really high. So it is slowing down, but yeah, it's still something to kind of keep an eye on, I think.
Yeah, inflation's a weird one, very psychological as well, because you can get to that point where I think we're a fair way away from that point, but it's almost as though people start to expect inflation. This is when inflation turns into hyperinflation. Hasn't happened. I don't think. Has there been much like hyperinflation in the US or Australia? I don't know. I'm not good with my economic history, but not actual by definition hyperinflation.
I mean, as far as it got in the US and Australia is 15 or so percent, I think, or 10%, which is really high. Like that shouldn't be understated, but nothing like what Zimbabwe seeing with 1,000,000% inflation. Numbers, and
that's the thing. That's the thing which is interesting about inflation. It can be very psychological. So you can get into this trap of everybody expects prices to continue to rise. So, people like, for example, I did a video on the Zimbabwean hyperinflation once, and it got to a point where, store owners would come out and adjust their prices several times per day. So the loaf of bread, they would market it in the morning as, $3, and then later on they would mark it as $4, and then later in the day they'd mark it as $6, and then $10 tomorrow, $15. And they were like at the worst, I think they were getting millions, if not literally billions of percentage points of inflation per month. Which is obviously at that point the currency is toast, and people just started using US dollars.
Well, the higher that inflation gets, the more it just drives people to spend, because if you have $1,000 or if you have $100, just to keep it simple, sitting in a bank account, and you're confident based on the recent numbers that that's going to be worth 10% less, for example, in the next year, and the other way you could think of it is the thing you want to buy is going to be 10% more expensive in the next year, then you're probably just going to go out and buy it. Why would you
get it now?
Especially when we're in this environment with 0%, you're earning 0% in a savings account. So there is a massive incentive to buy things that you're probably going to buy at some point over the next 5 years. Like people probably think, well, maybe I'm going to buy a car over the next 5 years, or I don't know, maybe I'm going to buy a new TV over the next 5 years. And if people start to think, well, I've got money in my account, I'm not earning anything on it, and inflation is now it's 5.4%, it's going to 6%, people might go out and spend, and that drives inflation even further. So it'll be interesting.
That's a good point.
It'll be interesting to see what happens with it. We also look at core inflation, which is this new. Well, I don't know how recent it actually is, but
what is that?
So core this is the thing with CPI data and inflation is they're always looking. This is just my opinion, but I feel like economists are always looking for ways to manipulate data to give to support like their opinion about what is going on.
Confirmation bias. Yeah.
So core inflation is this measure that is a measure of CPI, so the increases in consumer prices, but it excludes food and energy. And the reason why is because those two areas are notoriously very volatile. So it kind of makes sense on a month-on-month basis. I mean, sometimes fuel, I'll talk about fuel in a second, like gasoline and petroleum. Sometimes they go up massive rates over short periods of time. You probably even notice that if you just go to the petrol station, right? Sometimes it's 10 cents higher or 10 cents lower within a month or a couple of days. It's very volatile. So it can kind of cause the inflation number to look worse or better than it actually is. But core inflation rose 0.3%. And as I just said here from the article, economists believe that this is a more reliable indicator because it excludes the volatile changes in food and petroleum prices. And that actually, that 0.3% number is a lot lower than the overall inflation number. And that actually is because energy prices rose significantly during the month. So gasoline was up 2.4%. month over month. And I mean, gasoline's up, I think it was 41% year over year. So, that's just an example of, and maybe in the next year it's down significantly. We had just, a couple of years ago where there was a massive oversupplying in gasoline, or maybe it was even last year.
That's right.
Prices went down massively. So it can be very, very volatile. So it does make sense in a way that you want to maybe exclude it and look at what the core inflation is. But to me, food is volatile, but it's also very, very important to consider. You can't always exclude it. One of the biggest movers in the inflation numbers was food away from home, so like eating out. That was up 0.8%. And while that may reflect just a volatile period, it also could reflect a long-term trend. I mean, we've spoken about a number of different restaurants that are like Chipotle, for example, that have had so much demand and actually increases in their costs that they've actually put in significant price increases. And that might not be something that is just this month. That might be something that is sustained over time. So overall, fairly interesting number. The only other thing I wanted to include was the year-to-date inflation. So just this year, the first 7 months of the year, we're at 4.2%. So probably going to be I would imagine in the 5 to 6% range by the time we get to the end of the year. And
you'd imagine so.
Yeah, and the big question is it transitory? Brandon, is it going to go away?
Oh, why do you ask me these questions,
Hamish? Crystal ball.
Yeah, this is you getting me back for asking you where Robinhood's going to be last week.
What's 2022 inflation going to be, Brandon? What's the CPI?
Sorry?
What's the 2022 CPI going to look like, Brandon?
Jeez, oh gosh, it's going to be go bold. It's going to be 20%.
Oh God.
And the world's going to fall to pieces.
Oh my God.
No, but that is interesting. Now that I know what core inflation is, that is kind of bonkers that they like to use that number more. I do understand your rationale and why they do it with food and energy being quite volatile. To be honest, I don't think food is particularly volatile, but maybe I just don't know enough about that industry. But energy, you can understand. You go to like the petrol station and it's like, it's $1.30, and then it's $1.50 per liter or something. But it's kind of weird if they're trying to get like an understanding of real inflation. I feel like core inflation misses the point because, I mean, if there's two things that people like citizens, us on the ground are definitely going to be buying, it's food and, energy costs, power or petrol and stuff like that. So, that's weird. And I do think what your little conspiracy theory, you might be onto something because you see it all over finance too. Even when it comes to earnings, it's like there are 3 different measures of profitability, and it's like, which one fits the story? There are a couple of different margins you can use. There's earnings per share, diluted earnings per share. It's just like there's there's EBITDA. It's just all these, or adjusted EBITDA. It's just so many little numbers that you can pick that better suit your story. That you always have to do a little bit of digging to make sure that the truth is actually coming through in the article and it's not just the numbers presented as per the author's opinion. Yeah, exactly right. In terms of that was pretty much it I had for that story. The market didn't react too much just because the numbers were fairly in line with expectations, which were probably already baked into the market. But nothing too crazy happened in the market overnight. Up slightly, so slightly happy, I guess, with the numbers. But we will see. We're still seeing big year-over-year increases, big month-over-month increases. If it's transitory or significantly transitory and it's going to go away, then we should, I guess, expect to see that towards the end of this year. So we will just have to wait and see what happens for the rest of this year. Yeah. Should we talk about the Olympics? Yes. Run us through. Quite topical. I didn't even know, to be honest, I didn't see much of the Olympics. We came 6th. What? Do you know that? We came 6th in the Olympics. That sounds good. We're a pretty small country. It does sound good. Sorry? We're a pretty small country. Yeah, well, that's what I think. It's like, we got 26 odd million people and we're versing, up against China and the United States, and they've got several hundreds of millions of people. Yeah, I feel like 6 isn't too bad. Who won the Olympics? Good on us. Who won?
Yeah.
The United States.
Right.
I get confused because I can't remember how. I think the way that they score it is just on gold medals. So the country with the most gold medals wins, and if there's a tie, then the tiebreaker is the total amount.
Oh,
I think it's the total amount of medals. I could be right. I don't know. But yeah, very interesting. But you hear these, I don't know, rumors, stories going around that the Olympics, is the Olympic Games going to still be around in 10 to 20 years from now? Because the truth of it is, and I was doing a little bit of digging, the economics of the Olympics are actually terrible. They are so bad. The Olympics costs so much money and it makes basically no money. Let me tell you about it. So first of all, let's talk about cost, right? So I was reading this article and I was saying that Tokyo initially said it would spend $7.3 billion on the Olympics, but a 2019 government audit put the actual spending around $28 billion.
Whoa.
Yeah. And, fair enough if you think, oh, okay, so Tokyo stuffed up, but it's surely not like that every single time. Every Olympics since 1960 has run over budget at an average of 172% in inflation-adjusted terms, according to an analysis by researchers at Oxford University.
Wow. You know what? In a way, that doesn't really surprise me because it's always this huge. I mean, you always hear about these cities that have the Olympics and they build all of these arenas and everything. They do all of this infrastructure, and then when everyone leaves, it's just like abandoned, and it's just like a mess that they've like created for like what 2 months.
And I believe a part of the Olympics now is they have to have a plan for returning either tearing it down or repurposing the venues for public use. Yeah. But for a lot of things like there are a lot of temporary structures. For example, like most cities don't need an Olympic water polo arena. So that's like generally like a temporary structure. But yeah, it's very strange. And I watched a video by the B1M that's talking about how London, after their Olympics, how they actually their plan to repurpose all of those buildings, all of those stadiums, which ones were, how they were downsized because obviously the capacity for the public doesn't need to be anywhere near as large. But yes, very, very interesting. So that's another factor of it. But yes, the Olympics definitely costs a lot. Every Olympics since 1960 has run over budget. They concluded that this was the highest overrun on record for any type of mega project, far exceeding roads, bridges, dams, or other major undertakings. For the 2016 Summer Games, Rio de Janeiro budgeted $14 billion and spent an estimated $20 billion, according to data collected by the Council of Foreign Relations. Sochi, Russia, budgeted $10.3 billion for the 2014 Winter Games, spent more than $51 billion. And London, the summer host in 2012, aimed for $5 billion and spent $18 billion.
Wow.
It's crazy. Sorry, you go.
I was just going to say, it's crazy how much it varies. Like Russia spending $50 billion. Like what did they...
Yeah, I reckon.
What's going on in Russia? They need
gold-plated.
They need someone in there who knows how to manage money.
Yeah, I reckon. But it's so interesting because the Olympics is so expensive and everybody knows that their budgets just balloon out. There are actually very few bidders for the Olympics. Like for the 2022 Winter Olympic Games, there were 2 bidders.
Wow.
2. China and Kazakhstan. And China got it. For the Summer Olympics in 2024, there were also 2 bidders. This is the big deal, the big dog, the Summer Olympics in 2024. 2 bidders, the US and France.
I did not know that there was so little countries that wanted to do it. That's crazy.
For context, there was 5 bidders for the 2000 Olympics.
Right.
The Sydney Olympics. 5 bidders. So it's ridiculous. And it's kind of crazy. It's either there's 2 reasons for it. There's firstly, countries themselves just don't want to host the Olympics because it costs so much. And actually also, beyond that, many times countries are really keen to host the Olympics because it's going to put our city on the map or whatever. And a lot of countries bid for the Olympics, and then before the selection process, they actually withdraw their bid voluntarily due to public outcry.
Oh.
Like literally the citizens say, we won't vote for you because citizens know that they're going to be the ones that are paying for it.
Yeah,
and they know that it doesn't make the Olympics doesn't make money, so they're just going to pay for this big spectacle where everyone from overseas gets to fly in and have a great time, fly out, and then they're left with the bill.
Yeah, that's kind of
and actually, sorry.
No, I was just going to say it is kind of crazy because I presume you got some like ticket sale numbers and that sort of thing, so we can kind of put this like 20 billion, 50 billion in perspective as to kind of what they're getting out of it. But I don't know. It is. You would think that it could work economically, that it could be this big spectacle that generates a lot of revenue, but I guess maybe not.
Yeah, there's a few keys to that. I think the biggest key would be to already have the infrastructure for most events.
True.
But there's so many costs which make it hard to keep the costs down. They have to build the athlete village. They have to obviously cater and provide accommodation for X amount of people. It's just ridiculous, and the costs go on. And it's also, people find it really hard to keep a constant understanding of the budgets for the Olympics because some numbers they include this and don't include that, and it's just a bit of a mess, really. But yeah, so most people, honestly, they just don't want the Olympics. And in fact, I found this article which said recent polling suggested that 83% of people who live in Japan believe the Olympics should not take place in the country this summer, a stark rebuke to what is typically a joyous event. Opposition to the Tokyo Games from Japanese citizens has been consistent throughout the year, according to polls. The Tokyo Olympics estimated cost was 20 to 30 billion, and we're going to start talking about revenue now. So 20 to 30 billion. I think the government audit put it at 28 billion. And the total revenue projected from the games was $6.7 billion. Yeah. However, that estimate was expecting ticket sales, which obviously never happened. And ticket sales were projected to be $800 million. So in $800 million, so that's $5.9 billion in revenue estimated. And it cost them, $28 billion. I mean, as an investor, if I come to you with a project and say, hey, look, I'll give you a good deal here. Give me $28 billion, and in return, I'll give you revenue of, $5.9 billion. That sounds like a good deal, right? You want it? You want it?
I mean, honestly,
do you want
it?
It's sign on the dotted line, Hamish. Sign it.
Sounds like half the business is in the stock market at the moment. That'd probably have, if that was a company, that would have a $1 trillion valuation.
Yeah, that's what they need. Oh, take the Olympics public.
Yes, that's what they need. And then you have stupid investors who just want to throw money at things.
It's the Olympics.
Yeah.
I want to own the Olympics. Tell you what, that's probably not a half bad idea.
That is, ridiculous. I can't believe it's such a bad. I mean, but it does make sense when you explain the infrastructure side of things. It would be like if I don't know, if every year the NBA had to build new stadiums. Like to host the NBA's regular season. That would obviously cost billions of dollars to do every single year, and that just chops out the entire margin, I guess. So yeah, that does make sense. Maybe they need to just host it in like the same city. Maybe we just need to find an island, and we'll just every country can chip in.
Yeah, the Olympic island.
Yeah, exactly. How cool would that be? You have this massive island. And people can go fly into this island. Every country can have a little shared ownership in it.
That would be sick. In fact, that's actually this article interviewed someone who's studied the economics of the Olympics for the longest time, written 3 books about it or something. And this person said the number one solution to keeping the Olympics viable is just have one designated place where the Olympics is held.
Yeah, I mean, it makes sense.
Unpopular opinion. But I mean, it does make sense. And he spoke about the reason why it shifted around so much is because back when the Olympics, in the early days of the modern Olympics, plane travel, overseas, travel was still for the average Joe quite inaccessible. So they moved around the Olympics so that it would go around the world and, people could experience the Olympics. But obviously they were saying now, well, maybe not right now with COVID, but generally speaking now, obviously international air travel is as easy as it's ever been. You can stay overseas and it's fine. It's not going to, it's expensive, but it's not going to cost you, an arm and a leg kind of thing.
It's not inaccessible. Like
it's not inaccessible.
Was inaccessible for the vast majority of people unless you had, unless you were ready to spend like thousands of dollars. So now, it is expensive. In a way, I guess you would say it's still inaccessible to a lot of people, but it's a lot cheaper, a lot more accessible. That's an interesting point. I never really thought about that, but that makes a lot of sense. Like when did...
So this guy's literally saying, look, we got to keep the Olympics alive. This guy wasn't even particularly bearish on the Olympics. Like he likes the Olympics, but he was saying if you want to keep it alive, just have one designated place where the Olympics are held. And it's just insane. It also... I wanted to just, I've got a couple more facts here. So that I just spoke about the Tokyo Olympics, 28 billion, and they were going to bring in 6.7 after ticket sales, which never happened. For more context, I found the 2008 Beijing Games generated 3.6 billion in revenue. But the host city spent more than $40 billion. And then the 2012 Summer Olympics in London generated $5.2 billion compared to $18 billion in costs.
Wow.
So it's not like this is a once-off because of COVID and they're not making money. This is like an every time thing. It's pretty insane. Yeah. But you know what? Is it 2032, I think? Brisbane is hosting the Olympics.
Yeah.
Which got me thinking... Are we going to be paying for this? Like, is the Australian taxpayer just going to have to foot the bill, or is it?
Oh yeah,
surely it can just be Queensland, right?
Just Queensland. I don't know how that works. Actually, is it the city that would pay for that, or would it be part the city and part the federal government? I don't know.
Honestly, I have no idea. Because I could make the argument, you could make the argument, you live in Melbourne. You don't live in Brisbane. Yeah. You probably won't go to the Olympics. Why should you have to pay for something that's up there in Brisbane?
I probably would go.
Yeah, I probably would go as well.
But yeah. No, I don't live there, so why would I have to pay for it?
Yeah, ridiculous. Exactly. But there you go. The Olympics, the grave economics of the Olympics. Turns out it's not actually a good financial thing. They'll say, "Oh, but don't you think it's good? It's people coming together on the playing field as opposed around the world, coming together on the playing field as opposed to on the battlefield." And he's like, "Yeah, I get the symbolism, but it's pretty expensive symbolism, isn't it?" Makes sense.
Oh dear.
Anyway, let's talk about Phil Town.
Yeah. So
what's going on in Phil Town's world?
I haven't spoken about Phil Town in so long. I feel like we haven't actually. In a long time.
We just briefly touched on him talking about Alibaba last week. But
did we? Did we talk about his Alibaba position last week?
Just a little bit because we were talking about China. Remember the Chinese crackdown? Right.
Yeah. So I thought we could maybe talk a little bit more about his SEC filing. So I think maybe we mentioned Alibaba briefly, but didn't go into some of the other things he's been doing, which I thought we could talk about. But of course, he manages a fund, Rule 1 fund, and they actually have over $100 million in assets under management. So it's a pretty big fund, and as of last year, I believe we started to see these filings, quarterly filings, where he reports what's in the portfolio, so we can see. I actually didn't know this, but the Rule 1 fund is like a small fund that sits within World Funds Trust, which is actually the fund that ends up reporting to the SEC. So it's really difficult to find the data. But fortunately, Investing with Tom, buddy of ours, actually put together a video breaking down the data. So I'd recommend you go check out his channel and his video where he actually went into the SEC filing and was able to show Phil Town's overall portfolio.
Right.
But essentially, there was...
So sorry, just quickly, is this World's Fund Trust like a collection of other funds?
Yes, I believe so.
Oh,
yeah.
Okay, right.
Yeah, so Phil Town, he basically made two significant moves during the period. We spoke about Alibaba last week, which now represents, I think, about 4.4% of the portfolio, so a pretty significant investment. But he also invested in another company called Sprouts Farmers Market and invested 4.5% of the portfolio in there. So he, it was a big quarter for him, actually. He added, 9%? 9% of his portfolio changed during that period. So I thought I could kind of go through Sprouts a little bit. I had to dive into the company. I thought it looked interesting. The surface level numbers look really good. I mean, the company's growing revenues and profits and equity and that sort of thing at double digits consistently over time. It looks like a really, really good business on the surface. And I think there was a comment on our last podcast about someone wanting us to look at this company, but I feel like
because we mentioned it, we just mentioned it quickly last week.
Right,
we're talking about how it's a comparative to Whole Foods, but we didn't know too much about it. So yeah, I'm interested.
Yeah. So since then, I've done a little bit of research into the company, and basically it's a relatively small organic grocery chain. So they have 362 stores. As mentioned last week, they compete directly against businesses like Whole Foods, but also, of course, conventional grocers. And the organic food sales in the US have increased at a rate of 10% per year for the last 5 years, I believe it is, which is really, really fast. So particularly over the last few years, the popularity of thinking a little bit more about having natural and fresh and organic foods has driven these grocery chains to perform quite well. However, there's a few things that I really didn't like when I was looking into this business. So I'll talk about those things, and then I'll talk about the one thing that I think is probably the best thing about this business and likely why Phil Town, I think, invested in the company. But I mean, there's a few things. I mean, in terms of the management team, that I like to see the founding family still running the management team, or at the very least, a management team that's been there for a really long time. So we can look at their track record and we can see what the management team has said over time, how they set goals and whether they hit those goals. It's just really valuable to be able to see the management team across time. This management team is now made up of 8 executives. 6 of them have come in just in the last 5 years, so new to the actual company itself, not just the executive team. So brand new team. The founding family was actually associated with this grocery chain and other ones for over 5 decades, and they are no longer associated with the company as of 2012. So that was kind of one thing that was a little bit of a red flag for me. Not that it means the management team is bad, but that we just don't have good data on them, and it makes it a little bit more uncertain. The other thing is that's quite negative is the revenue growth at their stores. So between 2010 and 2015, revenue growth was really good at their stores, between 6 and 8% of comparable store sales growth, which is really high, much higher than the average grocery store was growing during that period, which means that they were capturing market share, stealing customers from conventional grocery stores. However, in the last 5 years, that's really dropped down severely to 1 to 2%. And if you actually look over the 2-year comparable store sales from 2020 and 2021, it's now negative. To me, that's an indication that the newer stores, as they expand further across the US, are not performing as well as some of their mature stores may have done in the previous decade. So, I mean, a couple of things to think about, and things that I wasn't too happy to see that you might not notice if you look at their top level numbers, because they are growing at double digits and they're doing it by expanding their store network. But in my view, it's not enough for you just to be expanding the store network. I need to see that the underlying stores are doing really, really, really well, that they're attracting a lot of customers and that sort of thing. But there is one thing that I did like about Sprouts. I think the best thing about it is probably its valuation, which is probably why Phil Town's gone and wanted to make this investment. the good thing about management is that they make their expectations really clear. Like they have a clear plan for what they want to do over the next 5 to 10 years. They want to increase the number of stores by 10% each year. And they want to see low single-digit revenue growth at their stores. So if you combine those, you're looking at low teen growth, so maybe like 12% or something like that, or 11%. Right. And the stock's currently trading at about 10 times earnings. So if they hit those goals, the stock will do extremely well.
Wow.
So it's really just a matter of whether you think they will hit those goals, whether you trust management, which I don't, because they haven't been there for a very long time, but
they don't have the track record.
Yeah. It's difficult to say. Maybe Phil has some kind of inside information around the management team. Maybe he's met with the management team and, he can kind of squash some of the concerns that I have just looking as an outsider. But yeah, I don't know. What are your thoughts?
Yeah, there you go. It'd be interesting to really dive in and see how the management team over, say, the past 5 years or so have done. Go back and, I don't know, even listen to old conference calls and read about, how many stores they had, and then, how those new store additions have been performing and that sort of thing. But I mean, you're right. I wouldn't say it's a red flag, but I'd say it's a yellow flag when there's new management. I mean, it's something that you just got to keep a close eye on, because you're right, you don't know how their track record's going to be. But yeah, I mean, absolutely, in an ideal world, you would love for the founders to still be, if the business is performing well and it's run by the founder, then it's just like, oh yes, this is fantastic. Especially when you can just tell the founder is just so pumped up about their business. The classic example is like an Elon Musk, even though he's not technically the founder of Tesla or space. He is the founder of SpaceX, but you can just tell he is so pumped up about those businesses. He treats them like his own, like he spends more time with those businesses than his own children kind of thing. And that's a really helpful thing. And especially when you get founders, it's also the case usually that all of their net worth and all of their financial success is tied up into the success of their companies. So they work harder to make sure, obviously your interests as shareholders are very much aligned with their. It's just so many benefits of founder-run businesses. But yeah, I mean, I'm not surprised that even if there are question marks about the business itself, that big money managers are still buying it if it's got a good valuation, because I feel like for the big money, they're just accumulating so much cash. I mean, even Warren Buffett in the Berkshire annual meeting was saying, look, we're actually considering putting some money into some not so great, or investments that we don't know, we don't know the same amount that we normally would before we sunk money into it, which I was just like, wow, Warren Buffett's saying that? Are you serious?
Yeah.
So it doesn't surprise me. As soon as these institutional guys find a stock that's decently valued, they just jump on it, because I feel like they're really just stuck for opportunities right now.
Yeah, exactly. Fortunately,
especially they're running funds. They're running funds with investors that they've got to impress. So
yeah, exactly right. Just an added pressure that doesn't exist for us individual investors. But fortunately, I think next week we'll probably have the major 13F filings coming out for a lot of the big investors. So we'll be able to see portfolios for what, Berkshire Hathaway and Seth Klarman's portfolio, and I don't know, can't think of Monish,
all of them. Yeah. Yep. Charlie Munger, Daily Journal, although that really doesn't change much.
Yes.
Yeah, they're all of them. Michael Burry, all of them.
Yeah.
They'll be coming out. So expect a lot of interesting institutional investor discussion next week, I would say.
Yeah, absolutely.
I'm sure there'll be something. There'll be something in there that'll be interesting to talk about.
For sure. Where do you want to go from here?
Right. Do you want to jump into some Q&A?
Yeah,
we'll do some Q&A questions.
Yeah, we've got a few Q&A questions building up again. I mean, I feel like I say this every week, but we've always got quite a few because you guys always ask lots of questions, which is really good. Gives us lots of different things to talk about, especially when we get to the Q&A section. But if you do have any questions that you want to ask for next week's podcast, then make sure you head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Just click on the latest episode and leave your questions as a comment below that video. I'll ask this first question to you. Hey guys, what are your thoughts on holding legacy stocks? When I knew a lot less about investing, I bought a small amount of Eli Lilly stock. It panned out pretty well, but I don't know anything about pharmaceuticals. Should I hold it since it's working out or ditch it because it's a liability that I don't understand?
I've been caught in this position before, back when I didn't know as much as I know now about investing. And I held these stocks. What would you define as a legacy stock? Just a stock that's been, around in that industry. It's like a big classic, like a Telstra or something. Would Telstra be a legacy stock?
Yeah, I think so. Just a more mature business, blue chip.
Yeah.
I don't know.
Blue chip, yeah, defensive kind of blue chip. I can talk about this because I bought into Telstra back before I knew what I know now. And to be honest, I did a whole lot of learning. I read a whole lot of books and I realized that actually I don't know enough about Telstra to be holding the stock. But, it's a telecommunications company. There's probably some, internet's getting bigger and bigger, more data's being used, 5G's around the corner. There was a case where I could just stick with it and just let it, just hold it. I mean, it pays a dividend. But I actually decided that I would sell it because quite simply, I didn't understand it well enough. I just didn't have that confidence that, there were some industry-wide tailwinds that maybe Telstra would benefit from, but I just didn't know how they were going, like their own company plan to execute and what sort of growth that would make and what price that should send the shares to, et cetera, what valuation, what would be a fair valuation. So I just decided that, I don't understand it. I had made a little bit of money at the time on the position. So I said, you know what, let's just close it out because I think that's Warren Buffett. Warren Buffett's rule number one of investing is don't lose money. And I was in that situation. I was in a position where I could lose money quite easily because I didn't understand what was going on. So I just decided to take my money off the table. And make sure that I didn't lose money in that case. So. Do you have any similar stories, or have you not made this mistake before? Or?
No, probably pretty similar. I mean, I think like most people who eventually get into value investing, your investing doesn't start that way, and maybe you have a portfolio of businesses that you don't understand or that don't actually meet certain requirements, and that was certainly the case for me. I mean, I remember one in particular. There was a couple. But one in particular is Vocus Group, which is a telecommunications company in Australia, funnily enough. A smaller one than Telstra, though. And I bought into that company, and within a month or so, there was a takeover bid, so it shot up a bunch. But I knew absolutely nothing about it, and I ended up just selling that stock. I did the same with Ramsay Health Care. I held for a very short period of time. There was a bunch of businesses that I basically purged out of my portfolio after learning Warren Buffett's principles and realizing I really don't know what these stocks are going to do in the future. And if you don't know what they're going to do, then there's really no reason to hold on to it because it could just as equally go to zero as it could blow up if you don't understand it. So I did that with everything except I kept one position, which was National Australia Bank. And it was the first investment I ever made. And it represents less than 1% of my portfolio. And it's literally there for sentimental value. I just keep it there because there was a story Warren Buffett had about the first stock that he bought when he was like 11 or something and how he sold it a couple of weeks later. But if he had actually held it, it was like would have been one of his greatest investments or something.
Right.
So for sentimental value, I don't understand the business and it's very small, but I just keep that and I'm probably going to hold that stock and not touch it, not add to it, not sell it for as long as possible. So
I tell you what, You probably will do all right, because I mean it's big fat dividend. It's one of the big four Australian banks, fat dividends. I mean the banks aren't going anywhere anytime soon, so you probably, and it's your earliest stock, so you've got the longest compounding period on it, so you probably will do very well on it if you just left it.
Yeah, we'll see how it goes. It's done pretty terribly so far, honestly. It pays.
Oh yeah, they've been caught up in a lot of crap though, haven't they?
Yeah.
National Australia Bank.
Yeah, I mean all the banks as well through that, but yeah, it pays a 6% dividend.
Yeah.
But yeah.
Just let that compound over time.
Yeah, so not bad, not bad.
Yeah. All right, let's move on. I'll read you this one. Thank you for the podcast, guys. Thank you for listening. I have some questions for you. I heard from both of your guys' channels that you guys started a business. Can you talk about them a bit? Like, what do you guys do? What kind of business is it? Also, if any tips if one were to start their own business. Thank you as always.
Yeah.
You want to go first? Well, I guess we've both got businesses in our YouTube channels.
Yeah, and I think maybe when if someone's just watching the YouTube channel or say just listening to this podcast where we're so casual, it might not kind of click immediately that, this could actually be a real business. I know that certainly when I talk to people in real life and I tell them what I'm doing, like almost the first kickback is, but do you make any money doing that? Like,
I know, that's so true.
Like, it's almost like, oh, that's cute. And the thing is, I think a lot of people misunderstand how valuable it is to generate, 10,000 or 100,000 people of traffic coming through your channel every single week. And what that means for advertisers. So running ads through Google AdSense and generating ad revenue, direct sponsorships like the one we have with Sharesight, and then just also running our own programs or selling products. Like both of us have, Brandon has a course on investing and tax, and I have an investing community. Yeah, I mean, of course, the main reason I can probably speak for both of us. The main reason why we like doing YouTube and podcasting is because it's a really fun outlet to talk about a passion we have and engaging with the community. But if you put that to a side for a second, it's actually a really, really interesting business model to be able to create content and to get access to a huge audience quite relatively easily in a very niche area with very little to no marketing costs because people just come and watch because they want to watch the content. So the cost really is just the time and small amounts of money that go into creating the content. Yeah.
No, that's exactly right. It is like the whole YouTube business model, online traffic business model is extremely powerful. I always for people that don't really get it, I compare it to like a petrol station. Saying, okay, so you own, I don't compare it to, I contrast it with a petrol station. I'm like, okay, so you own the local petrol station. The people that come and buy petrol from you are going to be the people that literally pass your petrol station, physically pass your petrol station. Someone in Canada is not going to buy petrol from you. Someone in Sydney is unlikely to buy petrol from you. Someone in Perth is definitely not buying petrol from you. And then, if you wanted to get your name out there that you've just started up this new petrol station, you would have to pay for advertising. Get your name out there on the radio, on TV or something, that costs you money. So when you compare that to a system where we can make content, our product is are the videos that we make. And then when we make them, they can be viewed by anyone, regardless of where you live, as long as you've got access to the internet and watch YouTube, then you can check out our videos. So we do have people in Canada, India, Madagascar, everywhere around the world that tunes in. And then on top of that, if you make a good video, say if you make a good product, then YouTube will grab that video and they will basically advertise it on your behalf. They will pump it in front of more people, so that they click on the video and give you more views. So it's essentially like if you have a really good petrol station, then the petrol station god will just advertise your petrol station for free. So it's just, there's so many perks to it. This online business model is just so powerful. But but yeah, so that's definitely number one for me. And then I've got Profitful, which is as you say, just a couple of courses on investing, a couple of courses on tax in Australia. But yeah, man, just online business. The business model is just so insane. The margins are high. It's just it's very powerful, very powerful. And I really believe in what Gary Vaynerchuk says, where people should, like, businesses, regardless of what you do, should be making online content. Like, consider yourself in part a social media company, a media company. Make videos, because that's like free advertising. And if you do it well, there's no reason why those videos or those, pieces of content on Instagram or TikTok can't actually earn money themselves. It's just insane. It's really crazy how, I don't know, honestly, it's really crazy how profitable it can be as well.
Yeah. I know for sure when I started getting into this stuff, I really hadn't thought through like the economics of it, or like how you could actually make a lot of money, but it makes complete sense. I mean, if you have 1 million people watching you over the course of a year, so 1 million different people see your content at some point over the course of a year, and you are selling a product, let's say for around $100, and you can get 1% of people to buy that product, 1% of that 1 million people, you're at $1 million in a year of revenue. So it's when you think of it in that way, wow, I just need 1% of people to buy. And of course you have to have something good. You can't just, I mean, you have to actually be selling something good, or maybe you're getting advertising revenue out of that person indirectly from an advertiser. But when you think of it like that, the economics start to seem, really crazy. And there are a lot of people on YouTube that have 1 million people see their content over the course of a year. And some that have way more than that come through their content. So, it's crazy. It's volatile. That's for sure. It's absolutely not volatile. A steady, stress-free, business. That's for sure. 1 month will be up 50%, another month's down 50%. So you got to live with that a little bit, but yeah, it's been a wild ride, I would say, for the both of us.
Yeah, you can't bank on your earnings being consistent, can you? But exactly what you're saying. Like, if we get a metric on our YouTube channels called our CPM, which is basically how much we get paid per 1,000 views. Yeah. In fact, we get 55% of our CPM.
Yes, we get 55. Yeah,
because YouTube gets the other 45%. So for example, my 55% of my CPM is about $15. So, if the channel does, 1.5 million views a month, you can just do the basic maths on that. That'll be like $22,500, which is, so it's definitely, and that's why I say to people, people that just, I recommend people start YouTube channels, and they're like, oh yeah, but what would I talk about? I'm not interesting. It's too hard. I'm like, it's just such an opportunity. What if, you might think that nobody would watch you, but I mean, YouTube's got over 1.5 billion monthly active users. I mean, there's going to be an audience for every type of content. I mean, one of the highest paid YouTube channels last year was somebody that makes different types of slime and squishes it through their fingers. I'm like, come on. I mean, I could make some slime and squish it through my fingers. If I had that idea, initially I'd think, man, nobody is going to watch these videos. I literally make slime and then I go squish, squish, squish. But hey, there is an audience for everything. So, people that are on the fence want to maybe start a YouTube channel. I mean, give it a go. Obviously, different niches have different CPMs. Like we're in the highest, I think, by a fair margin, finance and investing. So I wouldn't bank on your CPM or your 55% cut of your CPM being $15. But I mean, there's still money to be made. It's just insane. It's insane.
Yeah.
Anyway.
Crazy.
Yeah. It's powerful. Give it a go. Start a YouTube channel, guys. Start a YouTube channel. All right. Should we finish up there?
Yeah. Let's finish up there. That was a good discussion, I think. Hopefully some people get some value out of those kinds of snippets, just stepping a little bit away from investing sometimes, talk a little bit about ourselves for a second. But thanks everyone for tuning in as always. As I mentioned, if you have more questions, feel free to head over to the YouTube version of the podcast and leave your questions over there. Thanks Sharesight for sponsoring as always. Sharesight.com/young investors if you want 4 months off a yearly subscription, or you just want to try it out for free. Try a free plan and have up to 10 holdings in your portfolio. Thanks Brandon for joining me as always.
No worries.
And we'll be back next week. See you later, guys.
See you then. See you later.